Hello students, welcome to EPG Pathshala. I am Ritesh Verma from Maharaja Agrasen College, University of Delhi. Today we are going to talk on module Valuation of Shares Concept, Need and Factors Affecting the Value of Shares from paper Accounting and Financial Analysis. Learning objectives. After studying this module, you may be able to understand what is a company, the concept of share and its classes, how equity shares are different from preference shares, the concept of valuation of shares, why valuation of shares are important, the various factors affecting the value of shares, and different values of shares. What is company? A company means a voluntary association of persons united for a common cause. It includes two important facts. First, voluntary association has large number of members, that it is not to be called a partnership firm. Every member of association has a right to transfer his share without the consent of other members. Hence, it becomes an incorporated body with perpetual succession and a common seal. It has a separate legal entity and it is an artificial person. It is managed by a board of directors duly elected by the shareholders. In India, companies are governed by Indian Companies Act 1956. This law creates it and dissolves it. Now next, what is share? Section 2, subsection 46 of the Companies Act 1956 has defined share as a share in the share capital of the company and includes stock, except where a distinction between stock and share is expressed or implied. Shares must be numbered so that they may be identified. They are movable property and can be transferred to any other person in the manner provided by the Articles of Association. In fact, a share is an interest of the shareholder in the company, measured in the terms of money for the purpose of liability in the first place and of interest in the second place. A share is a right of a company carrying with it certain rights and liabilities. The share capital is most important requirement of a business. It is the amount which is initially invested by the shareholders and it is divided into a number of fixed amount and each small units are known as share. Nature of share. According to section 44 of 213 Act, the shares shall be movable property transferable in the manner provided by the articles of the company. Shares of a company are created as goods under Sales of Goods Act 1930. These can be bought, sold and hypothecated. Numbering of shares. According to section 45 of 213 Act, every share of the company having share capital shall be distinguished by its distinctive number, provided that nothing in this section shall apply to a share held by a person whose name is entered as holder of beneficial in such share in the records of depository. And most important note here is that the 2013 Act clarities that the provision regarding distinctive number of each share shall not apply to a share held in demat mode. Types of shares. According to section 86 of the Companies Act, a company can issue only two types of shares: preference shares and equity shares. Preference shares. It carries a preferential right in respect of the dividends and capital. They are entitled to receive the fixed rate of dividend out of the net profits of the company specified in the articles of association. For instance, 5% preference shares. It means these shareholders are entitled to get 5% rate of dividend, whereas no such percentage is fixed with equity shares. But there is one limitation of the preference shares, and that is it does not carry any voting rights except on those issues which affect their interest, such as non-payment of dividends for more than 2 years. Preference share classes. Cumulative preference shares. When the arrears of dividend are cumulative and such arrears are paid before paying any dividend to equity shareholders. Non-cumulative preference shares. The dividend is payable only out of the net profits of each year, and if there are no profits in any year, the arrears of dividend cannot be claimed in the subsequent years. Participating preference shares. They are entitled to participate in the surplus profits with the equity shareholders after they get a fixed rate of dividend on their shares. Non-participating preference shares. These shareholders are entitled only to get fixed rate of dividend and do not share in the surplus profits. Convertible preference shares. Those shares which can be converted into equity shares within a certain period. Non-convertible preference shares. Those shares which cannot be converted into equity shares. Redeemable preference shares. A company limited by shares may be so authorized by its articles issue preference shares which are redeemable as per the provisions laid down in Section 80 after fixed period of time. Guaranteed preference shares. These shares carry the right of a fixed dividend even if the company makes a profit or not or insufficient funds. Equity shares. The shares which are not preference shares are equity shares. These shares do not enjoy any preferential rights. They rank after the preference shares for the purpose of dividend payment and repayment of capital. The rate of dividend is also generally not fixed and may vary from year to year depending upon the profits of the company. But they are the real owners of the company as they have voting rights in the management of the company. How equity shares and preference shares are different. Basis of dividend. Preference shares have fixed rate of dividend, whereas equity shares don't have any fixed rate of dividend. Priority. Dividend is paid on priority to preference shareholders. Dividend cannot be paid before preference shareholders to the equity shareholders. Refund of capital. Preference shareholders have preference as regard to refund of capital over equity shares. Equity share capital cannot be refunded before preference shares. Bonus share and right share. A company cannot issue bonus and right shares to preference shareholders, whereas bonus and right shares can be issued to the equity shareholders. Arrears of dividend. In case of preference shares, arrears may accumulate in certain cases, whereas in case of equity shares, there is no provision to pay arrears of dividend. Voting right. Preference shares don't have any voting right, whereas equity shares have full voting right. What is valuation of shares? The capital of a company is divided into number of equal parts. Each part is called share. Each share has a fixed face value. Shares are shown in the company's balance sheet at their face value and not on market value. Thus, it is necessary to calculate the value of a company's share on a particular date, and the process to find out or calculate the value of share is called valuation of shares. In other words, valuation of shares means to find out that price which is used for purchase and sale of transfer or tax assessment of shares or for any payment in the form of shares. It provides correct information and states about the position of share capital, the amount invested in the form of shares, to the shareholders and various other interested parties. It should be remembered that as per Section 2, subsection 84 of Indian Companies Act 2013, share means a share in the share capital of a company and includes stock. Different authors' view. The underlying principles of valuation of shares are by no means difficult, but their application calls for a considerable knowledge of technical points. William Pickles. According to B.S. Kothari, the valuation of shares is not an exact science and cannot be reduced to rigid rules or formulate. The valuation of two persons hardly agrees, and there is wide divergence in the valuation made by different valuers and tax authorities. Need or purpose of valuation of shares. Under the following circumstances, the valuations of shares is important. Number 1. On amalgamation at the time of purchase, when two or more companies doing similar business go into liquidation and a new company is formed to take over their business, it is known as amalgamation. In such a case, purchase consideration is the price which is paid by the transferee company to the shareholders of the transfer company. Now, the purchase consideration may be paid in the form of shares, and it is agreed that purchase consideration will be calculated on the basis of the intrinsic value of the share of the transfer company, and the intrinsic value of share can be calculated by dividing the net assets by the number of shares of the paid up capital of the company and for that, valuation of shares is necessary. Second, on the internal reconstruction of the company. Under internal reconstruction, a company continues in its legal entity and is only recognized internally under Section 319 of the 213 Act. The objective of internal reconstruction is to reduce the value of shares to their actual value, that is, to reduce the share capital to the extent to which there is deficiency in the value of assets. Therefore, in such a case, to determine the amount payable to the decent shareholder, valuation of share is important. Third, on conversion of shares, where share of one class to be converted into shares of another class. For example, conversion of preference shares to equity shares. Here also, point to be noted is that only convertible preference shares can be converted into equity shares. Shares of private companies. Generally, shares of private companies are not quoted on the stock exchange, and if shares of such company are to be purchased or sold, the value of such shares will have to be calculated. So here also valuation is required. Next, appraisal of the shares. When the shares are not quoted in the stock exchange, the value of such shares has to be ascertained. Next, for taking loan on shares security, where loans are raised on the security of shares of a company, it is necessary to ascertain the value of shares. Next, for the valuation of the assets. The valuations of shares are made by companies to find the correct value of its assets for declaring the net asset value. Next, for determining gift tax. When shares are received as a gift, it may be necessary to place a value on the shares for the purpose of assessing gift duty payable by the receiver. Next, nationalization of companies. When government wants to compensate the shareholders on the nationalization of a company, in such a case, it is important to value the shares. Factors affecting the value of shares. The factors that affect the value of shares of a company are similar to those that affect the value of goodwill of the company, as both are interlinked because goodwill is the reputation of the company. The principal factors affecting the valuation of the shares are: number one, earning capacity of the company. The following facts are considered in this regard: average profits earned in the past, and average profits can be calculated by dividing total profits by the number of years. The lowest and highest profits earned in the past. The average rate of return on capital employed. Profits remaining after paying tax and dividend to preference shareholders. Recent events and those likely to occur which will affect the profits. Second, efficient management. The companies which have good management and progressive life generally command good value of shares in the market. Third, rate of return in the same type of industry. The value of a share will much depend on the dividend yield that the investor expects to get as compared to the normal rate prevailing in the market in the same industry. Fourth, accounting ratios. A company with sound accounting ratios like current ratio, liquid ratio, inventory turnover ratio, debtors turnover ratio, creditors turnover ratio, net profit ratio, etc., is favored by the investors and have the high value of its shares. Fifth, government policy. The government offers special incentives for particular type of business. For example, tax concessions for companies in backward area, and if a company enjoy such concessions, the value of such shares will increase. Sixth, fully paid up or partially paid up shares. Investors take a negative view of the partially paid shares, which may reduce the value of shares in the market. Seventh, demand and supply of shares of the company. If shares of a particular company are demanded high, then it automatically lead to increase in its value. Eighth, dividend policy. Dividend is the part of the profit which is distributed among the shareholders. Preference shareholders are entitled to get fixed rate of dividend, whereas equity shareholder will get the dividend only when company earns profit. If company follows stable dividend policy, then it fetch high rate of its shares and vice versa. Ninth, net tangible assets of the company. Those assets which can be seen, touched, and moved from one place to another. Other factors like nature of a business, future prospects of the industry in which a company is engaged, capital structure of the company, number of shareholders, extent of competition, extent of government control on company, position of a peace and security in the company, political conditions such as fear of nationalization, etc. Different values of shares. A difficulty arises regarding the valuation of shares, as shares have different values which can be explained in the following manner. Face value. A company may divide its capital into shares of different denominations like 1, 2, 5, 10, and 100 or any other suitable amount. For example, the total capital of a company is rupees 20 lakhs divided into 2 lakh shares of rupees 20 each. This face value must be printed on share certificate. Company's share capital is known as per the face value of share. Share may be issued at less or more price of face value. It is also known as par value. In simple words, shares can be issued at par, more than par, or less than par. That is, shares having face value rupees 10 can be issued at 10, 8, or at 12. Book value. The full value of shares does not represent the true worth of share of a company. Book value can be calculated as reserves and accumulated profits are added to share capital of company and accumulated losses is to be deducted from the share capital, and the remainder represents book value. This figure then will be divided by number of shares, and the result will be the book value of the shares. Cost value. Cost value refers to those prices on which the shares are purchased from the others. It also includes the purchase expenses or the cost incurred while purchasing the share, such as brokerage, commission, etc. Market value. Market value refers to those prices on which the shares are purchased or sold in the market. This value may be more or less or equal than that of face value. It is important for the companies to publish the value of share in the leading newspaper, daily media, put on the websites of stock exchanges, and communicated in electronic form. Capitalized value. The average profits of the company are capitalized at normal rate of return. This is called capitalized value. In order to find out the capitalized value of each share of a company, this capitalized amount is divided by a number of shares of the company. Some important terminologies. Company. Company is a voluntary association of persons joining hand together for the common goal. Share. It is a small part of the capital. Capital. It is the amount invested by the shareholder. Dividend. Dividend is a part of the profit which is distributed among shareholders. Shareholder. The holder of share or a person who possesses shares. Consideration. The price which is paid by the transfer company to transferee company. So students, let us summarize what we have learned in this module. The capital of a company is divided into number of equal parts and each part is called share. There are two types of shares, equity and preference shares, and the holder of share are called shareholder. Each share has its fixed face value and shares in the company's balance sheet are shown at their face value, not at the market value. Thus, it is necessary to calculate the value of a company's share on a particular date, and this process is called valuation of shares. There are a number of circumstances which arise in a company when valuation of share is important. Say it is at the time of amalgamation, on reconstruction, when shares have to be converted, and even when appraisal of shares being done by shareholders. But there are number of factors which affect the value of share which need to be considered while valuation. In this module, we have also studied that shares have different value, so in order to depict the real value of share, all these aspects have to be considered. Thank you.